Well, welcome to Sigma Hour. Um, the session is designed to highlight Alpha Alternative's risk management philosophy and capabilities. Our aim is to leave you with a better understanding of the role of risk management in preserving performance through economic and market cycles and illustrate how a risk culture must integrate with our commercial objectives in order to be effective. We divide the next hour into two parts. We begin with an overview of the challenges we face in markets, some of which we have heard in the last 2 hours, and highlight some unique approaches to risk identification that we believe enhance performance. In the second half, we illustrate the application of these risk management approaches in three of Alpha's products. Sorry, Prashant, the previous slide, please. Thank you. Um, so far, in Alpha Hour, we have described how Alpha is created, and outperformance is derived from operational, financing, and structural insights. In the Beta Hour that just concluded, fascinating range of global opportunities and market dynamics and global geopolitics that seem to interplay with each other to arrive at what I would call an investment thesis or philosophy that is ultimately compounded by risks that we aren't always able to identify or even measure or monitor. In other words, risk management underpins our ability to either seek beta, seek alpha, or create alpha. And in general, when we think about risk, we think of it in, broadly speaking, two base categories. The first, I would say, is what we do on a normal basis, risks that we are comfortable with, risks that we are able to normally manage on a day-to-day basis. And I would put, for example, managing an options book as part of our daily management of risk, where options price volatility is a function of our delta, gamma, vega approaches, and these are part of our standard risk management strategies. However, my role in this hour is to really demonstrate that we can generate further outperformance by identifying risks that are harder to measure and monitor. And these risks are derived from a variety of what I would call market structural issues. Now, for example, Nick in the previous session described a number of risk factors that are related, if you will, to market structure. He talked about inflation risks. He talked about central bank response functions. He talked about the transmission mechanisms of various global macro events through either currencies or other asset classes, etc. And the challenge for us is really to identify is for us to really think about how these various risk factors, the catalysts behind them, and the attribution of these catalysts can play a role in our investment decisions and help us to build portfolios that will sustain performance through these cycles. So an area that I think has been, I would say, less well understood is the role of market behavior, or the behavior of market participants in the market as it relates to how they drive liquidity. Because we all know liquidity dries up when we need it the most. And what does really liquidity mean? It means our ability to sell or buy when we want to. I think of it as a proxy, if you will, for the combined behavior of all market participants. Now, let's think of an example that was raised earlier with long-term capital management. Now, in 1998, Russia defaulted on its debt. It devalued the ruble, and long-term had three main problems with their business model. Firstly, their convergence trades assumed a certain convergence between what they were then trading off-the-run treasuries versus on-the-run treasuries, and they expected that convergence relationship to hold under all market conditions. They didn't anticipate a flight to quality that would be triggered by the default that Russia's default would trigger. And when a flight to quality takes place, the market converges to the most available liquid instrument, in this case, the on-the-run treasuries. The basis widened dramatically between the off-the-run and the on-the-run, and they didn't have enough capital to post variation margin, and therefore had to essentially, close down their fund. So this gives you an example of how liquidity plays an indirect role. It also highlights where the lack of appreciation of where these risks were factored in other words, not taking into account the fact that a flight to quality could arise for a variety of reasons. In this case, Russia was the primary casualty. And through that, not planning in advance for what could happen in the event that you have unexpected large losses. Okay. There was a question earlier on beta in the market today, and where does the alpha generation take place in the context of a very high beta market? And my response to that is that in addition to all the comments that were made earlier, timing of beta and knowing when to reallocate a beta strategy is also a form of alpha. In other words, understanding the market drivers behind beta and knowing when to take your foot off the gas pedal is also an important dimension of understanding these markets. So alpha can take many forms, and although and in this case, I think it relates back to what we think of is in terms of cycles, because cycles, we've talked about that. Nick spoke to cycles of various kinds. He talked about economic cycles, business cycles, and indirectly on market cycles. And so therefore, at various points, it's important to understand how these cycles behave, what are the drivers behind these cycles, what are the inflection points, and to what extent can we anticipate these inflection points? And then most importantly, how do we allocate resources appropriately? A simple example would be if you take the diagram on the top left. Phase one is clearly not an area where we want growth equities, but phase two and phase three of an economic cycle is clearly where growth equities will benefit with tailwinds. Market cycles, on the other hand, are fascinating because they embed several timescales. And each timescale can be thought of as being an investor with a different horizon and different risk objective. These timescales are important to identify. And based on these timescales, it is a question of how does one actually decide when to enter the market and when to exit the market. And this goes back to the earlier question on beta. You can think of the beta today as being a shorter term time scale, that when we know that this beta ride will saturate, it would be an opportune time for us to actually exit the beta trade and enter into a more distinguished stock picking or more differentiated allocation strategy. So again, I think that these are important nuances that come up, and I think the idea of misalignment of your asset class to the timing and the cycle is an important element of risk that is oftentimes not fully appreciated. Third element of risk, which I think is critical, and I highlighted this earlier with long-term as an example, are the losses that can arise due to uncertainty. Now, risk and uncertainty are generally intertwined. Risk is generally, we think of risk as the likelihood of being wrong because it's generally measurable. Uncertainty, on the other hand, is proxy for how much we could be wrong by, and for the most part, it isn't easily measurable. And so we need to find ways in which to protect ourselves against what I would call uncertainty, knowing that we're going to take certain risks. Now, long-term capital, as an example, didn't take adequate protection because they were uncertain. The uncertainty wasn't how much capital they would need to post variation margin. They didn't have enough capital because the risks that they saw weren't sized appropriately to reflect the actual impact on their losses. Similarly, Paulson, another example that was raised in the Alpha Hour, when he literally swam against the market. He was one of the few investors that decided that BBB subprime mortgages were going to essentially go to zero in value. And he was able to take advantage of that. But what happened there was that when we think of the banks who had issued these mortgages on the other side of this transaction, they were all sitting in crowded trades. They had very little understanding of the correlations in these portfolios, and as a result of which, when these subprime mortgages began to lose value, everybody had to run for the door simultaneously, and the value of these securities went from par to zero in a very short period of time, resulting in significant capital losses for the banks. So again, fat tails where you have unexpected large losses arise when we have these systemic risk events. They happen when we are uncertain about the shape of our return distribution. So in this example below, we see the shape being dictated by the variance, which is the red line, which is, I would say, so think of the blue line as being your expected return or your expected behavior, if you will, and the red line being the unexpected behavior. And the unexpected behavior creates a fatter tail, which arises in the larger expected loss, larger than expected loss than we had planned for. And so trying to calibrate and measure these differences is an important step as part of our risk management exercise. Okay. So how do we put all of this together? A risk budget is a convenient tool to help us quantify our capacity or tolerance for uncertainty. And in the cartoon, we show a very simple risk decision. It's a binary outcome. If the mice go for the cheese, it's either success or failure. In real life, risk outcomes are far more complex and lie on a continuum, as we illustrate below. We need some mechanism to enumerate the scenarios, the sensible scenarios that we want to immunize ourselves from. And we use an intuitive approach that I'm sure many of you in business use all the time, stress testing and scenario design. Now, stress testing obviously can mean many things to many people, but in the case of financial markets, we must know what variables to stress and by how much. And the figure shows that for a given performance target, which is the vertical blue line, we need to build in a risk capacity, which is the green line, or risk capacity or tolerance above our risk appetite, which is the red line. And the blue, the turquoise blue represents the risk profile of the underlying portfolio. And so when we combine these, we have a simple risk appetite framework together with a stress test that designs that designs a risk capacity or risk tolerance for a given target return that we have in mind. And that sort of framework is applicable across many asset classes and portfolio construction. Okay. So in the first session, we discussed the idea of a PCV product with the objective of really creating a collection of products to which we would allocate capital based on where we felt was the best risk reward profile. This slide is really meant to highlight the implication of what that does. So typically when we look at returns and volatility of returns, we don't always take into account the correlations of these returns. And so even though the risk, if we take this table, for example, the return to volatility ratio for both assets in this portfolio are the same. It's a ratio of 2. And so intuitively, you would think that it doesn't matter whether you have a 50-50 allocation or not. But it turns out that because these are correlated, the intuitive allocation of 50-50 doesn't really apply. It's more of a 40-60 allocation, and we can work that out mathematically. But the point here is that it's not always the case that the obvious answer is the right answer. We have to be nuanced about how we construct the portfolio. And as we put together diversified products on the Alpha platform, combining these products together in a smart manner can create a optimized return profile for the asset allocation process. And so the argument here really in this slide is to show that having an asset allocation across multiple products is actually a very efficient way to allocate capital. Okay. So when we combine, clearly complexity hasn't been our friend, because as we've seen earlier, we have a number of risk types that we've tried to highlight as being important for investments, and yet we haven't really spent much time on deconstructing these risks and how do we identify them, how do we monitor them, how do we measure them, and that I hopefully will be for another session with some of those who may be interested. Okay, so in this slide, what we've done is we've tried to take the compendium of risk management strategies and put them into 3 buckets. Okay. There's a static bucket, a dynamic bucket, and an opportunistic or tactical bucket. The static or preventive risk measures we put these in place prior to allocating risk capital, and these require a detailed understanding of current risks and how these risks may evolve, allowing us to build in protection for less liquid strategies or strategies that take more time to rebalance. The dynamic or defensive risk management approach are measures we take in real time, reflecting the price risks that are based on market cycles, and embed some of the market structure risks we highlighted earlier, such as liquidity, behavioral risks, of liquidity risk, correlation, and volatility. Okay, and the opportunistic when risk premium varies across markets, and as Nick pointed out earlier, we need to be able to identify when is an opportune time to identify a dislocated risk premium. Recognizing outsized risk premium and having dry powder in which to take advantage of this outsized risk premium is a critical step. So we will address each of these 3 in some detail over the next few slides.